You may learn about investing and how to make the best financial decisions for your life on Investor Facts. Make sure you click the subscription button and enable the notification bell if you haven't already. Share, like, and comment. It's safe to say that October is off to a solid start. And it appears that the bulls are expecting that the Fed won't be aggressive moving forward, as you have consistently urged. The summer bear market rally was supported by this attitude, but ultimately, fresh lows were reached. What do you think the current market attitude is? It's interesting to see that our flagship strategy did not reach new lows, but this is very common as a bear market comes to a conclusion. Even though the overall averages did not reach new lows last year, we managed to hold on to our prior low, which occurred in mid-May. As we emerge from a bear market and, if our predictions are correct, as the Fed approaches a pivot, whether by rhetoric or otherwise, innovation tends to be the new leadership. It's possible that something similar is occurring in the United States, and there could be, soon, a significant deflation. Commodity prices have been collapsing one after another. That's the beginning of the pipeline, and at the end of the pipeline, stockpiles are overwhelming businesses and consumers aren't being as cooperative as they once were. As a result, we anticipate that this holiday season will be challenging and involve a lot of discounting. The Fed will likely to be taken aback by the deflation pressures that begin to affect the headline inflation numbers over the next 3 to 6 months, in our opinion. Do you believe it's possible? The fact that our main trading partners are experiencing a recession is something that the Fed is likely considering. In addition to current economy's weakness, they are undoubtedly on alert, but there are also indications that the financial services industry is in turmoil. There are tensions and strains in the financial system, which I believe initially manifested themselves with the LDI issue in the UK. We've been watching the credit default swaps of money center banks double and triple. And in Europe, they're at all-time highs. If you look at Chairman Powell's usage of Volcker's name and his book title, you can tell that he believes we are going through a significant financial shock because, in his opinion, we are having inflation similar to what we had in 1970s and 1980s. In the face of double-digit inflation, Chairman Volcker increased interest rate from 10% to 20%. I think credit default swaps are increasing for a reason, and we will discover that those reasons are over time. Chairman Powell and his team have raised interest rates 13 times for their lows, and we believe that when history is written, economists will be looking back at this and saying, "Wow, what a shock to the system." The rate of inflation for consumer goods has increased, and I believe it may reach 5%. I anticipated that it may peak at around 4%, but things have gotten out of hand, and rents are now rising sharply, which is a result of rising home prices, at least according to inflation gauges. Contrary to our expectation, oil prices have risen about $70. As you are aware, given that technical advancements make innovation inherently deflationary, we have a predisposition to emphasize deflation. We do have that bias, but I can tell you that with the PPI reports coming considerably higher than expected, together with the CPI numbers, I would have anticipated further bond market declines and an increase in interest rates as a result. The bond market is smelling something, and I think it's an indication that additional deflationary pressure are beginning to build. Growth isn't made enough investments to prepare for the new world, and trust me, even industry is going to be revolutionized. As a result, they will face intense pricing pressure as their products finally become obsolete. What might be the determining factor in the dollar's increase? It is true that increased corporation taxes rates won't have such a negative impact on the terms of trade for the United States. In actuality, everyone in the world will now be affected by this minimal tax of 15%. Some of the most successful tech companies have been able to keep worldwide taxes at extremely low levels. But since this is true for everyone, the dollar may be strengthening over the long term for this reason. We predict that the combination of electrical and autonomous electric vehicles will lower oil prices. As I've already stated, it is just my opinion. We haven't done the study to support it. However, I believe that we could return to the oil prices that prevailed in the early 1970s after the cartel gained control, when they ranged from, I believe, $3 to $12 per barrel. I wouldn't be surprised if we went back eventually, especially since electric vehicles are starting to take a significant share of the market. The number of traditional manufacturers who are now pulling out all the stops and creating and producing electric vehicles because they are better cars, better for the environment, and better performers will also help, in my opinion, hasten the shift towards electric vehicles. From the perspective of the customers and from the perspective of adoption, their prices will keep falling. For once more, there is a deflationary undertow there before cyclical deflation. The bond market appears to indicate that this is what is happening, but is that accurate? The majority of the people don't think 1.5% is a true interest rate, so they've been normalizing. I evaluate how market multiples have performed in terms of the equity market. They have been pricing or valuing equities based on assumed normalized interest rate of roughly 4%. But what if it isn't? What if it is only half that amount? That would be extremely important to secular growth organization, especially given the amount of confusion that will arise from all the innovation, which will be exciting, and the destruction, which will be, well, pretty disheartening. It will be crucial to be on the right side of change. According to the National Bureau of Economic Research, the sharpest recovery from any recession has been the sharpest recovery from the shortest recession, and the sharpest recession in post-World War II history. In a sneaky way, it makes sense that the monetary policy would normalize now that we are out of danger, and in a sneaky way, it may already be doing so. Money growth is decelerating fairly quickly and trading quite quickly. Thanks for watching the entire clip. If you like it, kindly let us know by hitting the like and subscribe buttons. Also, don't forget to enable the notification bell so you can be the first to know when we post a new video. In the following video, I'll see you.